Welcome to the stock play of the day. Today's stock is the XLF, that is the financial ETF. We will discuss today, should we pass or should we play? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest.
And I'm Lindsey Bell, Chief Investment Strategist with Ally Invest.
All right, Lindsey, well, we have a graph of the S&P 500 index. What's going on with the markets this week?
Well, that's a pretty good looking graph, Brian, that you've got there. What we're seeing today is a rebound off of a strong Friday and a pretty solid week last week within the S&P 500. Again, we're seeing today, like we saw on Friday, really investors are completely ignoring the spike in coronavirus cases. Florida hit a new all-time daily high in cases, and they're really focusing on a couple of different things. First and foremost, a vaccine. Good news came out this morning about Pfizer and their German partner, BioNTech, and the vaccines that they're working on. Basically, they're going to see a fast track of the testing of those vaccines for two of the four vaccines that they've been working on. That follows news last week from Gilead, their remdesivir drug, showing signs that it's preventing death in those that are having very severe cases of coronavirus. So that, along with a little bit of housing data that came in better than expected, and PepsiCo kind of kicking earnings off a little bit here this week, is really adding to the optimism I think that you're seeing in the market today. Of course, the tech sector continues to lead. I know you're going to talk about that a little bit, but like I mentioned, we're going to get into second quarter earnings results this week, kicking off the banks tomorrow. We'll talk about, as you said, XLF is the stock play of the day. So we're going to get into the details of that. But basically, when you think about earnings right now, it's not a pretty picture. Expectations are for the S&P 500 to show EPS declining 45% in the quarter on a year-over-year basis. We haven't seen that number. You have to go back all the way back to 2008. So the question is, do investors care? This is supposed to be the trough in earnings. I think most people are going to be looking out to 2021 to making sure that earnings per share in 2021, based on consensus estimate numbers, about $162 per share. They want that to stay pretty stable because everyone's kind of looking past 2020, right? It's been a horrible year. Second quarter is supposed to be the trough in earnings. We're supposed to see an improvement over the next two quarters, even if they are sharp double-digit declines. But the real looking out to 2021. So there's still a lot of uncertainty out there, Brian. And, you see the tech continues to lead the way. I think it's become more of a defensive sector in this environment where there's a lot of uncertainty, in addition to the fact that people are learning new ways of living and working from home, and being connected. And so I think they've been able to accelerate growth, pull it forward in a very quick manner. We've heard a lot of CEOs talk about that. I know you and Callie talked about the tech sector a couple weeks ago, so you're seeing the NASDAQ up today. But Brian, you're also seeing the VIX up sharply today. And what Callie Cox, our senior investment strategist here at Ally Invest, she ran some numbers, and she said the last time that we saw the S&P 500 within 5 percentage points of a new all-time high and the VIX at this type of level was 1999. So what do you make of it? There's all this optimism in the market, but the VIX is saying there's a lot of volatility expected still. And we do have an uncertain economic environment.
Right. So we got a party like it's 1999, according to Kelly, I guess. All right. So if I look at this and I just looking at the chart, one of the things, we have a trend line that was drawn last week in the S&P 500 index. And we see that we broke through it and then bounced back up. And then we had 1, 2, 3, 4, 5 days of consolidation. So right now, based off of the opening on the market and the big run up that we've just had, look at where my crosshairs are we're right by that June high in the S&P 500 index. So a very crucial time period to see if we break through that. And if you go all the way back to March, and I'm going to move my cursor all the way over here, try to keep my line kind of straight right there, we see that there was that big gap. That was the big gap down that we had in before the pandemic started. That was the big shock to the market. So if we could ever break through that, it would be nice to try to fill that gap, and that would be a good thing for the S&P 500 index. And you and I talked a little bit earlier before the call started, and one of the things that I did say when I was talking with Lindsey is, if you're looking at the way the SPX is setting up right now, I actually even talked about just looking at a long straddle, maybe in the SPY, the ETF that tracks the SPX, because the market's just getting ready to spring, and we don't really know which way it's going to go. If you look at the SPX, it paints a lot different picture than the NDX. But here we did get the bounce, and it looks like we're trying to set a new high since June. I'm going to emphasize June, and then we got a gap to fill before we get back to where we were before the pandemic started. So I'm going to jump over here, and this is you're talking about Lindsey working from home. I'm actually on vacation in northern Wisconsin right now in my parents' basement, and I'm doing this radio show. So I've got a couple of little things going on here. But with that said, here's the S&P 500 index. This was actually levels that Callie and I were talking about. These are a couple of trend lines that were drawn from that show. And we see that basically the NDX has gone parabolic. One of the biggest concerns here is that we've just gone straight up. There's been no stopping, and that always makes you a little nervous because markets just in general usually don't have a tendency to not stop at all and take a pause. So in the NDX, it's just been extremely bearish. The SPX is a totally different story, but it was very interesting to see the open, and like we talked about, we even had a gap open in the NDX. So that just makes you a little bit nervous, and I think that's part of the reason why we're seeing the VIX index actually go up as the markets are going up, and it's going up a decent percentage. It's about 1.5 points right now, with a big move up in all the indexes across the board. The Russell 2000 index still can't really decide where it wants to go. So the main story nowadays has been the NDX, the NASDAQ, and the S&P 500 index, the SPX. All right. So with that said, we got earnings coming. We got a lot of earnings coming, and the financials are going to be a big group of the pile of earnings this week. So let's talk about the XLF. What are you seeing in the XLF? And I'll pull up a chart.
Yeah, sure. That'd be great. So before I get into the XLF, just a reminder to all of our viewers, two things. Number one, that anything Brian and I talk about is just we're just teaching here. We're looking at charts, and we're trying to learn the fundamentals. And nothing we say should be misconstrued as advice. But second of all, we also take questions at the end of the show live from you, our viewers. So be sure to get chatty in the box on the right on the YouTube channel there, and we'll get to them at the end. Okay, so the XLF, Brian, thanks for pulling up this chart here. This does not really look like the S&P 500 now, does it?
No,
it is,
yeah.
right? So the financials have struggled throughout this rebound. That they are up 33% since the March 23rd low, but they've struggled a little bit, especially in recent weeks as the pandemic fears have increased. You saw them move up pretty sharply. There you see that move in the middle of the chart here. When things seemed to be getting under control and economic data was improving, and even the 10-year Treasury yield was, getting closer to 1. So they were benefiting there from a reopening trade, but they've struggled really since then. And we're going into earnings season this week. Tomorrow, JP Morgan, Citigroup, and Wells Fargo kick everything off. And the biggest question on minds when it comes to the banks is, how big are the provisions going to be, and how does that translate into earnings? And is this quarter going to be trough earnings for the banks? We know it's going to be trough earnings, or we expect it's going to be trough earnings for the S&P 500. But how are the banks going to fare? And I should be be sure to say the financials also include the insurance companies, which are expected to, you'll have to go back a couple weeks. Brian and I talked about the insurers too. So check that video to get our thoughts on that. But back to the banks here. Peak provisions, for those of you that don't know what provisions are, banks, basically what they do is they have to set aside a certain amount of reserves, is what they're called, for expected credit losses that they think are coming forth in the coming quarters, because people or companies are going to default on loans or credit cards or their mortgages and things like that. So they have to set that reserve aside, and that hurts their profitability. So they took big chunks of reserves last quarter. Everyone's expecting them to take another chunk this quarter, but hoping that this is the last of those provisions that they have to take. When you look at the other fundamentals of the company, it was a great, of these banks, excuse me, it was a great quarter for trading. Trading volumes were through the roof. It was a great quarter for investment banking. So that would be equity issuances, IPOs, debt issuance. Year, which is a pretty impressive number, but equity issuances, so those IPOs were up 81%. It's the second highest quarter of equity issuances since 2000. So that part of the business did really well. The M&A advisory business within investment banking didn't do as well. Like I said, trading, a separate business unit, should have done well. FICC, fixed income, commodity, and currency is also expected to be up 65% year over year for the medium bank, which is also good. But again, the loan loss reserves, building out provisions for credit losses, that's going to be a drag. Also, net interest margins. So this is basically the money they're able to make on the loans they have out minus what they have to pay depositors. And since we're in this really low interest rate environment, that the money they're making is become less and less on that. So that's going to be a drag. The question is, where do we go in the future? And as you know, I've been talking about extensively this earnings season, a lot of companies really, they withdrew or suspended guidance last quarter. I don't expect them to really reduce guidance this quarter, given there still is a lot of uncertainty, especially around the consumers and corporations, people working from home. Nobody knows when you're going back. Some cities are slowing down reopening efforts or completely shutting them down. So there's a lot of question marks out there. So the banks are really good to watch because you learn a lot about the economy and the consumer and all these other great things that can help guide you throughout the rest of earnings season. But overall, the expectation from my vantage point is I always look at earnings per share growth. Second quarter earnings per share growth, the financials are expected to see a decline of 51%. That's worse than the 45% decline expected from the S&P 500. But numbers have come down sharply going into the earnings report. And that's a good thing. That means the bar has been lowered for these companies. So nobody's expecting great numbers out of the banks, and the numbers have been reduced to help them beat, in a sense. So I think that could work well in their favor. The stocks haven't done much, so it could be an upside surprise potentially for these for this sector. So the XLF is one I definitely think you can watch, especially based on the fundamentals. So what are you seeing? What is your expectations from an options trade? Because it almost feels like this could go either way, especially with the reopenings kind of slowing down here.
Right. And I do, when I look at the chart, which I still have up here, I have my crosshairs, and this is just a very interesting area for the XLF. And what I'm going to point to is, first of all, if I move my crosshairs up just a little bit here, we see this gap. And this gap was created on the downside after the pandemic got going. And then the market kind of slower, not slowly, but slower trailed off a little bit more to the downside, but in a little bit slower fashion. But this gap is an interesting area in the XLF because you see it's been very volatile between those prices. So right now we see this is where we came back. We touched this high after the March lows and this high here in April. Guess what? We're right there again. And so it through this area, there's always a good chance that if you can get within the gap, we could fill that gap again and go back up to the June highs, just because of the volatility between these prices, as you can see here on the chart. Now, with that said, you're right. It's a volatile time around earnings, and earnings always adds a unit of risk to any strategy that you want to look at. We're going to look at a long call spread, and we haven't talked much about long calls. Just in general, because the markets have been volatile. We got the VIX finally going below 30, but now that's creeping back up. It's around the 28, 29 level today. So we still see a lot of volatility in the marketplace. And in the XLF, we still see implied volatility in that ETF up around 40%. In general, that's fairly high. Just overall, usually the XLF would trade down around 15 to 20% implied volatility prior to the pandemic. So because of that, we want to sell some options to reduce the overall risk of buying a long call. But we're going to get long going into earnings. It's going to be a speculative trade. We're not going to go out that far in time because a lot of the earnings are this week. So we're going to go out about 14 days and look at a long call spread in the XLF. Now, once again, this is not meant to be a recommendation. We're just trying to learn here. And if we're trading around earnings, we want to make sure that we're aware of the volatility impact on that strategy. So what we're going to look to do here is we're going to buy a little bit in the money call option and sell a little bit out of the money call option. So 18 days away, July 31st, that gives us plenty of time for the earnings to kind of shake out, if you will. And we got the XLF right now trading at 23.64. So we're going to go down and buy the 23 strike call, what is that, 64 cents in the money. So you're going to buy a little bit of intrinsic value, and then we're going to sell the 25 strike calls. Now that's right in the middle of that gap, and we're kind of hoping that it would continue on up. If you wanted to, you could go out and maybe sell the 26 or 27 strike call. But my concern there is that you're not bringing in enough premium to help offset the volatility that you're buying. So for example, like I said, the VIX index, this is the volatility index on the call options, is trading right around 42% implied volatility. That's high. We have earnings. The VIX is kind of creeping up a little bit. If I want to learn about how much premium I'm buying, if I'm buying an in-the-money option contract, it's mainly intrinsic value. But if I just look at the put, it'll give me a quick and dirty look at what the time premium might be in that call. And I want to use that to try to pick the strike that I'm selling. So if I'm paying about 60 to 61 cents, that's the bid ask, really good markets here in the XLF, 1 cent wide on the put options here. That means that you're buying, because this is the strike that we're buying, about 60 cents worth of time premium. So if I go up and I look at the 25 strike call, well, obviously this is an out of the money option contract. The coloring on the chains lets you see that. This darker blue color is in the money. The black color is out of the money. And if we sell that, we bring in 38 cents on the bid, 39 cents on the ask. Once again, a very tight market in the XLF. So we're selling about 20 cents more time premium, or less time premium than we're buying. And I don't mind that mix right there. That means we only got real susceptibility to volatility fluctuations and time decay of about 20 cents overall on the strategy. Okay, so if we look at this, this will be the official paper trade for the week. We're 2 points wide, the width of the spread from 25 to 23, so we're 2 points wide, and we're paying 86 cents if we can fill that on the midpoint. Okay, let's call it 85. And I'm going to put this trade in the right rail. That means it's the official paper trade when it goes in the right rail over here. And let me just summarize what we have. So Right now, my mouse isn't working, so I got to use my laptop mouse, but here we go. So we're buying the July 31 strike, or July 31 expiration, 23 strike call, and at the same time selling the July 31st expiration, 25 strike call. It's a 2-point wide spread. That's the maximum it could trade for. We're doing this for a net debit of 85 cents to the account. That 85 cents will be our max risk. So every 1-by-1 spread that we do that we can fill at a net debit of that price will be $85. That'll be our total risk. What's our upside? Well, we're going 2 points wide. So because we're going 2 points wide, that's the maximum it can trade for. Subtract 85 cents from that, and our upside will be $1.15 going into the earnings of a lot of the financial companies overall. So inside the options playbook, we have the long call spread. Here's a quick summary of a generic long call spread, just using basically XYZ fake stock and talking about strike A and strike B. And if we look back on the Ally Invest option trading platform, I'm going to move the trade because I got my screen really zoomed in right here. Let's remove our paper trade for the week. And I'm going to scroll down and we'll just take a quick look at the profit and loss graph going into this earnings week. Okay, so I'm going to zoom in just a little bit, and you see that this is very similar to the profit and loss graph of the long call spread inside the options playbook. But inside the options playbook, we're talking about the dotted line here. That's the at expiration profit and loss graph. The benefit of using real-time data inside the Ally Invest option trading platform is this colored line kind of shows what your outlook is right now. If we were to execute this trade at an 85-cent net debit to the account, the colored line will show you this is our max loss as of today, and this is our max upside. So what I'd like to point out is if your forecast is correct, you don't get paid right away by doing a long call spread because you're selling an option contract that's fighting, that wants the market to go down, and you're buying a more expensive option contract that wants the market to go up. So we have about 18 days remaining to expiration. Let's go and just move this graph, and we're going to make it 3 days. And now you see that colored line looks a lot more like the dotted line. So bottom line is, if you're doing a long call spread, you would rather be correct closer to expiration. So when you're doing these type of spreads, you got to be very particular about the expiration that you're buying, as opposed to just buying a call outright. A lot of people will err by buying too much time, by letting, or not necessarily err, but they would rather have too much time than not enough. You just have to be a little bit more specific on your forecast when you're looking at doing a long call spread versus buying that call outright. But the biggest benefit here is that we have an option contract that likes time decay, the one that we sold, as opposed to just owning an option contract that is always battling time decay, battling fluctuations in implied volatility. So here, once again, just to give you a quick peek at it, this will be the official paper trade for the week, buying the 23 strike call with the July 31st expiration and selling the 25 strike call with the July 31st expiration. All right, that's it for this edition. Oh, well, now let's get into the questions. Lindsey, back to you. Did we have any questions that popped up or any from last week?
Well, we've got a quiet crowd today, Brian. We don't have any questions, but again, we still have some time. So if you're watching and you have a question, definitely type it in the chat box and we'll be sure to answer it. But Brian, I had a question for you too. You were talking about time decay and how getting closer to the expiration usually benefits a long call spread. Is there any scenario under which you would exit this strategy early?
Yes, of course, the maximum that we can make on this trade, Lindsey, is going to be $1.15. So let's say I'm up $1 on the trade. Am I going to wait around just to try to get that last 15 cents when I got all the risk to the downside now, as opposed to the upside I can only make 15 cents more or 20 cents more? If I'm doing this trade and I know that my max loss on the downside is that 85 cents that I paid for it. If I get close to the maximum on the upside, I'm going to want to get out of the trade. There's just no reason to hang around and have that risk to the downside with out a lot of benefit to the upside if your forecast stays correct. So it's pretty by doing a long call spread here, we can kind of manage our risk parameters just by we're paying less than we could potentially make. We're paying 85 cents. We can make $1.15. So some people might take the approach that I'm just going to come back on July 31st and see, did I make that $1.15 or did I lose that 85 cents? Or am I somewhere in between? And I'll just kind of play it that way. But the active traders of the option contract might say, well, if I'm up $1, I'm going to get out. I could have lost 85 cents, but now I can make $1 on this trade. I'm going to get out of that trade. So the biggest thing that if you're going to approach it as I'm only going to lose 85 cents on the downside, I want to try to make this much on the upside. It's just important to stay consistent. If you have a plan going into earnings, and this is the reason why we're kind of talking about the XLF, and I just want to make sure I stick to that plan and I stay consistent when I continue to do this trade overall. Great question, Lindsey.
Thank you. Okay, so along those same lines, we did get one question from Stein 3D. If you buy extra time and then close out when the trade when you hit your targets, like you were just talking about, is that substantially different than picking the shorter expiration, assuming you could execute at a similar debit?
Well, the biggest part is the assumption that you could execute at a similar debit. If I'm looking at a shorter time frame, the risk is that the move's just going to happen after the expiration date. That's where the biggest risk is. I kind of like the time period right around 14 to 25 days on long call spreads, because you do need at least some time decay. The other thing that we're looking at here too, that will help your long call spread if you're correct on your forecast, is after earnings, implied volatilities have a tendency to go down more than go up after earnings. It's not always a given. There's no real givens in the marketplace, but that would also help if you were correct on your forecast. A bunch of companies come out in the XLF, they announce earnings. The day after, the market kind of goes up, implied volatility comes in, and the stock goes to the upside. That's a good thing. But also with that said, we always got to mention the bad thing. If that's true and the market goes down, a decrease in implied volatility can also hurt the position if you're wrong on your forecast. So I do overall like that range between 14 and let's call it 24 days out in time, because you get a decent rate of time decay on that option contract, but it gives you a little bit more time to play out.
Got it. All right. Well, that's great, Brian. I think that was a very helpful answer. That's going to do it, though, for our show today. But Brian's going to be back on Friday at noon to review this exact trade and make any adjustments if necessary, and really talk you through what's happened over the course of the past several days in the trade. Right, Brian?
Oh, yeah. So we're going to have the overtime edition at noon Eastern time this Friday on the Ally YouTube channel. So make sure you click subscribe and hit the bell so you get all the alerts. We'll see you this Friday.
See you later.